Welcome to today's Takeaway Thursday, where I will be recapping essentially how the FOMC press conference yesterday went and what ended up happening with the long-awaited Powell pivot. This video will highlight some of what Jerome Powell said that I thought was particularly important, both from a summary perspective as well as an expectations perspective, looking at what to expect from the Fed looking forward. There are four main nuggets of information that I found particularly useful from the speech. When asked about the lagging effects of monetary policy and the Fed's reaction function related to potential breaking of the economy, so to speak, Jerome Powell had this to say, quote, "Of course we think about lag. The lags are just sort of a basic part of monetary policy. But this is the important part here. Let me say this. It is very premature to be thinking about pausing." This is worth repeating. It is very premature to be thinking about pausing. Not even just pausing, to be thinking about pausing. And he continues to say, so people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. And if that wasn't enough, he goes on further to say, we have a ways to go, our policy. We need ongoing rate hikes to get to that level of sufficiently restrictive. This is my interpretation and evaluation here. A lot of market participants already believe that the Fed has over-tightened monetary policy. And here, Powell is saying that things are not yet sufficiently restrictive. Let's take a look at the next thing he says. We think we have a ways to go before we get to that level of interest rates that we think is sufficiently restrictive. More importantly, we think that the level of rates that we estimated in September, right, the incoming data suggests that that's actually going to be higher, and that's been the pattern. My interpretation again. Every quarter or so, the Fed releases their economic projections, and as a result of those projections, releases a dot plot of what they believe the terminal rate would be. That is the highest Fed funds rate that the hiking cycle will, terminate at. And what I believe he's saying here is that every time that they've released the dot plot, which is kind of their estimates of where interest rates will be, as well as their projections as to where inflation in the economy will be, they have always undershot or overshot in the wrong way, meaning inflation has always been higher, and as a result, they keep upping their estimate of where the terminal rate will be. And so what he's saying is that he thinks that the terminal rates are going to be even higher than what they initially predicted in September. But more importantly, he's cluing into the fact and that each time they come out with a projection, it's always higher. But more importantly, he's telling you that in his mind, he is realizing this pattern and that ultimately the terminal rate will need to be higher than what everybody hopes or believes it's going to be. Next, he says, and this is a direct quote, that they are trying to make decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control, because we don't tighten enough, now we're in a situation where inflation will become entrenched and the costs, the employment costs in particular, will be much higher potentially. Here, I think he's referencing to the fact that the Fed and the government were able to support the economy, specifically during COVID. And so here, I think he believes, and there is some truth to what he's saying, that if they're too hawkish and they tighten too much and things start breaking in the economy, they can always go back and support the economy. But the risk on the other side is much worse. And all of this is to say that the risk of doing too much is not as severe as the risk of doing too little. Again, All of this is to say that he expects to keep hiking rates, and we should believe him on that. Finally, he said something very interesting that I haven't seen a lot of people really pick up on, and that is the following, quote, "It used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before the expectation of monetary policy, because the markets are thinking, what is the central bank going to do?" And he further says, quote, "Plenty of economists think that once financial conditions change, that the effects of the economy are actually faster than they would have been before." And I took this to mean that the long-held philosophy that monetary policy acts with long and variable lags, meaning the effects of rate hikes won't be felt for some time, a year to a year and a half later, is actually not true. And he has some theories about this, primarily that financial markets, specifically the bond market, are trying to front-run the Fed. And in doing so, they tighten financial conditions way before the Fed even enacts their monetary policy. For example, mortgage rates shot up very, very quickly, long before the Fed themselves actually hiked rates to those levels, right? And that was, the Treasury market front-running the Fed, but more specifically, the mortgage bond market before that, further front-running the Fed. And so you had this massive tightening in financial conditions and the economy overall before the Fed even got to those rates. Now, what I think that ultimately means is that Jerome Powell believes that the lag is not actually as bad as most other Fed governors or Fed watchers believe. And I believe that this would ultimately give him the confidence to keep hiking at a very purposeful rate, because if economic data doesn't lag policy by that much, then he should be able to see weakness in the economy happen as he's hiking and can ultimately back off. Again, kind of more evidence against a pivot by the Fed anytime soon. The key takeaways were essentially the following. The terminal rate and the time spent at the terminal rate will be more important than the pace of hiking. What's probably going to happen over the next few weeks is that people are going to speculate on what it is that the Fed is going to do at their meeting in December. And what I believe Jerome Powell is trying to tell the markets is that if all your time and effort is focused on this task, you're missing the point. You'd be better served by determining what the highest rate is going to ultimately be and how long the Fed will spend at that rate, and less so by how fast that rate is achieved. Powell expects that rates will be higher for longer. Additionally, when asked directly, Powell doesn't believe he has over-tightened. And finally, he believes that the risk of doing too little is greater than the risk of doing too much. All of this is to say, I don't believe that Powell believes that he's anywhere near done hiking rates. And we as investors will be better served by not trying to predict whether he's making a mistake, but rather trying to predict what he'll actually do. So I hope you guys found this useful, and to end, I'll leave you with a meme. Yes, I'll pivot, but from hawkish to more hawkish. And I believe that's exactly what happened yesterday.